Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. G'day, mate. Welcome back to the show. It's always good to see you.
It's good to see you too.
Today, we're going to talk about some of the volatility that we're seeing in markets. We're recording this on February 25th, which is the day after the news outlets are reporting that Russia has fully invaded or started to fully invade the Ukraine. So there's been a lot of volatility. We've heard the US president come out with his response, which was more sanctions. So if you're listening to this a little bit later, just keep that in mind. But we're going to talk about 6 companies, 6 really interesting companies. Some companies at the time of recording are way down from highs, but are bouncing back. And so we've got a really interesting mix of companies here. We'll spend about 5 minutes on each of those 6. But maybe to start off with, mate, volatility, it's everywhere at the moment. People are scared. People are writing into me saying, I'm down 30% this year. My portfolio is looking scary. Should I rebalance? Should I sell? Should I go to cash? What are you seeing out there? Like just general strokes, I guess. How are you seeing things?
Well, when I last checked my portfolio, I haven't checked in a few days, and I have it set to at least the one portfolio where, where I look at things. The other portfolio I actually don't pay that much attention, which is probably a good thing. And they're very similarly positioned. I saw my not year to date, 1 year returns were minus, I think, 28%.
Wow.
So yeah, and that was a few days back. So it must be a lot more negative now than it was a few days back. So yeah, I think it was, my 1 year return was now minus something 28%. How does it make me feel? Not great. But you know what, I think it's a part and parcel of investing, especially I invest in high growth. I know that you do that too. If you invest in high growth, volatile stocks, they go up, they go down. It's part of it. I don't sell out of anything, and I'm not a big fan of selling something to buy something. So I'm just trying to find whatever cash I can. I'm saving on that, not having that avocado toast and trying to put that money too. I'm having peanut butter and jelly right now, and I'm putting everything that I can. I've basically been investing regularly. I've been doing it roughly at a 3-week cadence, trying to invest every 3 to 4 weeks, because it looks like you've hit the bottom, and then the bottom falls, and again you think like it has hit the bottom and the bottom falls, right? So, but a lot of companies are bouncing around a lot because a lot of them are, I think, in value price range, but that doesn't mean that they can't get any cheaper.
Yeah, that's right. Yeah, it's really interesting. So there's one thing I want to dive into really quickly in just a moment, which is why you are not a fan of selling and then buying. But I'm exactly in the same camp. So I'm scratching around for every last dollar that I can find, basically, to put money in. Like I did this miniature budget of the next 2 months. And I've basically given myself a 2-month window to save as much money as I can and invest it. And I just run it down to the line. I'm not saying, I don't think either of us are predicting that, hey, in the next 2 months or next 3 months, things are going to be back to normal by no stretch of the imagination. But what we're saying is there are shares that are down, companies that we wanted to own for a long time. And even, for me, even things like ETFs, I'm just pretty much buying. That's basically what I want to do is just buy. So that's what I'm going to do over the next few months. Hopefully we can catch up and talk about some of those purchases. But so can you just maybe, this is a really important question we're getting a lot from our members is, why don't you sell and then buy other positions?
Yeah, so one of the things, I try to own companies I really like, right? And so selling right now would mean I'd have to sell something like, say, Apple, which has fallen a lot less compared to other companies, and then sell Apple and buy something else. Apple is probably down only 10%, maybe, and some other stuff is probably down 30, 40, 50. There are companies that are down 80% from highs, right? So, but I don't want to do that because I've held Apple since maybe 2011 or 12. That's, you know, a huge multi-bagger position. That's like a huge tax bill if I sell some. And it just doesn't make sense to sell some Apple. You know what I mean? So, and then I could sell some companies. I think, you know, if I had to sell, I would look at companies that are not executing very well. But some of those companies, I find that they are, even if they're, you know, not executing the best, they're so dirt cheap that I can't just justify, you know, selling them at this valuation. I guess if I get desperate, that's where I'd start at the bottom of the pyramid, looking at those companies that are not executing. But I don't like selling any company that is doing well, executing fine, because it effectively means I have to make two decisions, right? I have to get the sell decision right. And then, you know, in terms of that company not being market beating, and then buying another company, which has to be market beating, at getting two decisions right is really hard. So I have tax considerations that I put into play. And then there's this consideration of getting two decisions back to back right instead of getting one decision right. And I just don't like to cycle. And for every company that I mentioned that is not doing well, because I have this tendency of not selling things, the companies that are not doing well, because I don't add significantly to my losers, it's not something that I do, or I've stopped doing. They're really tiny positions. Like, I mean, you know, I'm not going to get a big bang for my buck. I guess if I sell all of them, I'll get some money that I can deploy somewhere else. Probably, maybe it is worthwhile, but yeah. So I try to avoid that complex decision making, and try to keep it simple. I want to buy that. Can I find some cash? And, you know, I can save, you know, buy the cheap bread and have peanut butter and stuff like that. And maybe that helps.
Yeah. It's for people out there that are listening that are thinking, maybe I can't, you know, add extra cash to my portfolio. There's always things you can sell. So, you know, I've got a redundant iPad that I'm going to get rid of hopefully in the next couple of days, and that's going straight into the portfolio. So yeah, so it's a fascinating thing, right? Because obviously people are scared. They're talking about World War III and all this type of stuff. I don't necessarily have a strong view on that either way, but all I know is that kind of capitalism has worked for at least Western economies for forever. And so it typically rewards the investors. And if people like Warren Buffett and many of the value investors are anything to go by, it makes sense to buy when prices are lower. So that's exactly what I'm going to do. And sounds like you are too. So I hope that gives people some confidence in how to go about things and how to think about things. Obviously, not everyone's the same. If you have like a big bond position, you might use that as a hedge and then rebalance accordingly. I think that's prudent too. Mate, let's get into some companies. Let's get into some exciting companies. I think you're going to start off with Zscaler, trades under the ticker code ZS. Tell us a little bit about it. The stock tumbled. Really interested to hear about this.
Yeah, so Zscaler is a security company. They basically provide, cybersecurity solutions to enterprises. And the stock tumbled. I think like last one I checked it was down 16%. I was trying to really figure out what was wrong with the company. I couldn't, and I haven't read the conference call in detail. But the questions that I read, the analysts all start off by saying, "Congratulations, that was a fantastic quarter. You had a really hard comp, and you beat that comp. Well done." So I don't know what else was left. So so this company grew revenue 63% year over year for the quarter. Remember, this is a business that's now in excess of $1 billion run rate. It's growing at 63%. Here's the other thing: quarter over quarter. So if you look at the adjacent quarters, I think it was up 11%. Okay, that's again pretty phenomenal. And in terms of the growth rate actually accelerated. Okay, so I don't know what the market is here looking for, but I think I have a suspicion of what it is. Then the other thing I look for this is a software as a service business, is just remaining performance obligation, right? And the remaining performance obligation.
We've talked about that, yeah.
We've talked about this before. It's an important metric, tells you about all the contracts that are booked in that are going to be serviced later on. That was up 90% year over year. 90%. Okay. Very few companies do this sort of thing, right? This is a free cash flow positive. Yes, adjusting for stock-based comps and things like that. I have a suspicion as to what happened. I think the suspicion here is that their next quarter guidance is high on the revenue side relative to what the analyst expectations were. But I think on a percent basis, I think there is a chance that it may be slightly below what the analysts were expecting. I think if that is the reason it is down, that's a very silly reason for a stock to be down. I mean, analysts, if the analysts did a poor job of modeling the company, it's not the company's fault. It's somebody else's fault.
You can't say
anyways.
that.
Well, I don't claim that I just said my ballpark now. It's like a ballpark. If it's in the ballpark, it is in the ballpark. It's not far off from the ballpark. So yeah, like really exciting company. I thought the results were great. They're executing really well. They have a $5 billion ARR, annual recurring revenue target in the next few years. They're at about $1 billion plus right now, as I said. Huge opportunity. And security has never been more important than now, right? With war and everything going on, one of the ways war is waged these days is through cyber attacks as well, right? It's not just a physical war. There is an electronic warfare that happens at the same time. So really excited. In my view, in my books, the results were an A+. The market clearly disagrees. Maybe I should buy some tomorrow.
So if you had to give I know you said you haven't gone fully through the transcript yet, but if you had to give it a score, if we're doing, A+ down to fail, how do you think it fared?
I thought it was, as I said, I think it's an A+. I mean, 90% RPO growth, 62% revenue growth at scale, growing responsibility. I have a hard time giving it a lower score, right? And this is sort of the thing, right? Sometimes there's disconnect between the market and what an individual investor might think, and that is the individual investor's opportunity or advantage.
For sure. I've had a few results this week where I've just looked at them and I've thought, why? What's happened? In terms of the company's reported, shares have gone way up or way down, and some of it may be justified, but then you think, why has it fallen 30%, maybe 5%? And it's tending to be the companies that aren't profitable, which we've talked about in the past with interest rates rising, inflation, and all that. The fear of capital raisings and discounted rates and all that sort of stuff come into effect, which is reasonable because we've basically gone from 2021, which if you just take COVID out of it, from an investing perspective, it was a growth investor's dream. You come to 2022 and you've basically got everything piling on top: geopolitical concerns, inflation, interest rates, rebalancing the value and, rotating the values, I should say. And so all of a sudden, everything's pretty grim. But if you are long-term focused and you're operationally, if you're operationally minded, you're looking at the companies executing, good time to be an investor, great time to have some capital, as we've spoken about. So the company I'm going to talk about is PlaySide Studios. I thought this was relevant because A, it reported today, and B, we've spoken about it a lot on the show. I also get a lot of questions about this on Twitter, amongst some other companies, which people don't like me for speaking out about. But PlaySide Studios trades on the ASX. Ticker symbol is PLY. It's an Australian-based game developer. So it basically splits its business into a couple of divisions, but you can think of it as it has original IP. This is where it creates its own intellectual property. So it might license some sort of, brand, like say, some sort of movie studio brand, and then create its own titles, or it might work for someone else. And this is the other division, work for hire, which is where it creates, it works on projects for other companies. So for example, one of the things that CEO and co-founder Jerry Sakis said today was that I think they're the biggest third-party developer on Meta Platforms' Horizons project. So basically PlaySide is trying to position itself, at least here in Australia, maybe if not globally, at the kind of forefront of the metaverse game development kind of cycle. And it's still got fantastic mobile games. It's now building across platform. It's got a couple of games being launched across PC and console. What we're seeing with PlaySide is we're seeing basically its profile just shooting straight up. So not necessarily, we're not seeing it, in the clouds in terms of its revenue and these types of things just yet. But what we're seeing is a lot of attention put on it from brand owners, but also from other game publishers. So it's partnered with the likes of Activision recently, 2K, Shiba Games, Wax, like all of these different games houses that are really paying attention to what PlaySide's doing. To put it in context, they've got about 130 in their team at the moment, which is up hugely from PlaySide. But they are looking to, I think it's up to 160 staff in the next few months. One of the questions I asked Jerry Sakis this morning was, how are you going with hiring? Because gaming companies need the talent to create the games. And games are one of those things where you need the best talent to create the best designs, to create the best, just everything to do with a game. When you think about it, like the environments, the way the games are developed improves the development cycles, etc. And he said that he's getting a few hundred applications from developers each week, and they're taking on one or two. So there's a massive influx of demand from people that want to work for PlaySide from Australia, New Zealand, all around, while at the same time, most of the industry is going in the opposite direction. So traditional technology roles are moving towards this metaverse stuff. They want to work on these exciting blockchain projects. So PlaySide is getting a massive tailwind in terms of hiring and scaling its team. Anyway, revenue was up 87% to $9.4 million. The original IP division, which has games like Battle Simulator, Animal Warfare, which are on mobile, and Age of Darkness, which is still in soft launch. $6 million of that 9.4, so the majority of revenue. The work for hire revenue was $3.4 million, or up 65%. Now, one thing to keep in mind, which a lot of the questions on the call were talking about, which is something which PlaySide launched its own NFT, non-fungible tokens, for the game Dumb Ways to Die franchise. So basically, PlaySide minted its own NFTs recently, and it collected $8.4 million of revenue. If you're new to NFTs, you would think that $8.4 million of revenue came out of thin air. So that's still yet to be recognized on the income statement. That'll be in the next quarter. All in all, the business is still reporting a loss. So keep that in mind. It's really speculative. For a company that's now got $500 million market cap, once you include restricted shares, it's pretty exy. It is pretty exy. However, I think it's kind of going to become Australia's, if not already, Australia's biggest and best game studio and developer. So lots to like about the business. Just keep in mind, it's very speculative. I would give the report, like a B+, because maybe an A. Not an A+ because it's not profitable, but it's doing everything you would expect Jerry Sakis and his team to do. So that's PlaySide Studios. If you have any questions, you can always just reach out to me on Twitter at Owen Rask if you want to ask anything there. But mate, that's my number one. I went way over 5 minutes, so sorry about that. I'll be quicker on the next one. Your number two is Upstart. Trades under the ticker symbol UPST. Tell us a little bit about it and what's going on.
Yeah, so Upstart basically is a platform that, it's a platform in the US that enables consumers to essentially, or aggregates consumers who come to that upstart.com looking for a loan, personal loan, and it can automatically approve, personal loans based on some fields that you fill in without any human intervention, right? So it's an automatic machine learning driven personal lending facilitation platform. And I use the word facilitation largely because they don't actually issue the loans. The loans are either issued by partner banks or are conduited through partner banks and then sold off to investors who basically invest for yield. And some banks now, about 40 odd banks, are now using them, sort of white labeling their solution and using it to generate loans and provide loans to their own customers. So there's a lot of noise around this company. Recently, the stock has been, the valuation has been all over the place for this company in terms of its its stock price. I mean, the PE ratio or PS ratio for this company has been all over the place. Part of the issue was that one of the things that people are worried about is the company has been going down sort of the spectrum in terms of, what they call prime borrowers, or, borrowers with high quality credit scores, I guess, and going down that spectrum. What they have observed is some of the data that the bond rating agencies provide is that there has been uptick in loss rates or delinquencies from some of these borrowers. What the company is basically saying is that, look, this is expected because as people are coming out of sort of this COVID cash stimulation and type of environment, we are going to see more normal levels of losses. And as I say that, it's not that we know that we're going to see that type of losses that we are actually seeing. In fact, the loss rates or the delinquencies were subdued because of COVID, and it's fine because as long as the model accounts for that, and it's all good because, I mean, if you're charging someone on aggregate, let's say 20% interest rate or 15% interest rate, and then, you have a small percentage of those people not deliver, it's okay because the 15% interest rate on the others is going to cover for it, right? I mean, there is always delinquencies in loans, right? And
There
it's
always
just,
is, yeah.
this is a combination that matters. So anyway, the stock was up like 35% or 40% or something like that on the earnings news. It's been climbing a bit post, but this is a very profitable company. Revenue was up like some 200%. It's a and its EPS was up. I don't even know how much by a large number. And I think I find this company very interesting because there's a lot of debate around whether or not what they're doing can happen, because what their premise is to make credit more affordable and more basically assess people based on true risk. And the ability to assess people based on true risk means that you're looking at all these different types of variables that people didn't generally look at in the past and using them in models to actually predict what the true risk is, right? And somebody might be high credit worthy, but actually might be high risk. Somebody is not credit worthy according to current system, but actually may not be, as high risk as the current system thinks. Then there's, of course, the question of, you can lend to more people, but at maybe higher interest rates, right? So there's that type of opportunity as well. So there's a lot of debate around what they're doing. Does it work or not? In the meantime, this company is expanding into automotive, lending for cars or vehicle loans, and they have plans of expanding into small business lending and more shorter term lending programs, and then eventually getting into mortgages. So they're really going for the whole pie in due course. So I find this company very interesting and exciting. And, if it's one of those things that, if this thing works and its current results seem to suggest it works, then the opportunity is just truly humongous. And as sort of a platform provider, not a lending company, they, while they are exposed to sort of the cyclicality of lending, given that they're in a secular sort of growth type of environment, if they can keep capturing more banks and credit unions and things like that, they should be able to, smooth out that cyclicality to a large extent while being, this is a $1 billion plus run rate company right now. Yes, I really like it. I thought the results were excellent. I'd give it an A, not an A plus. I mean, I should give it an A plus for the earnings growth and stuff that it has delivered. And it's actually not expensive at all. I think the trailing PE was something like 60 or something like that for, with the E is growing at some, a really high rate.
Yeah.
So, a triple digit rate or something like that. So I'm still going to the A large because I think there's a little bit of unknown here, and the unknown is that only in the fullness of time do we know whether or not these algorithms truly work. So, but
I think this is really interesting company. So, for those listeners that are still a little bit confused about some of the things that it does, I was just looking at this. Like, it might take into account your education level or your employment, like where you work, your sector of employment, all of these different things to predict creditworthiness. That's kind of fascinating, and it makes sense, right? Because traditionally you couldn't really do that because it would be incredibly manual. But with obviously like big data and machine learning, you can identify patterns and use these things to predict creditworthiness. It's fascinating.
Yeah, absolutely. So you can, based on the type of education you're having, where are you having it, and what degree you are studying, what universities or colleges you're going to, you could pretty much stratify opportunities that lie ahead for the individual, right? And
for sure.
And therefore you are lending not based on trailing data, but effectively lending based on future potential in many ways, right? And if you think that, okay, they're going to soon graduate and have a job, well, they're maybe worthy of giving a credit right now, because they're probably going to land a job that will allow them to be, to pay the loans, right? So I think it's that's a nice example. I like it, Owen. Fascinating company.
I just might follow up with one more question, if I might, because this is really interesting to me. So revenue looks like it's gone up about 260% over the past it went from 2020 to 2021. So it's growing rapidly, and analysts are still predicting huge revenue growth over the next few years. So you mentioned that it partners with banks. Does it partner, and it kind of like partners to push the credit off? Does that mean that does it hold the credit risk on its balance sheet, or does it push that off to the bank?
No, so it funds some of the loans from its balance sheet, a very small percentage, only when they're trying out new things or making changes. So they don't send stuff off to their partner banks unless they are happy with it. You know what I mean?
For sure.
So they're not a lending company. So but they're still effectively lending in the sense this is they're not a lending company, but a still lending company in the sense that if their lending model breaks, then the partner banks are not going to act as pass through, right?
Yep.
So there are two types of things that happen. There's banks that are using them as white label solutions. Then there are banks which are also acting as conduit, effectively as pass through, right? Because they're not a bank, so somebody else is the bank that is creating the loan, seasoning the loan on their balance sheet for a few days, so that it's not a fraud, and then passing it off to institutional investors like people like Goldman Sachs who want to buy for yield, right?
For sure.
And then of course Upstart also facilitates basically securitization, which is basically taking a bunch of these loans and putting them together to create a bundle, right? So you can buy the individual loan, so you can buy the bundle. And that's just to provide liquidity to the investors, right? Because you provide that's what basically markets to a large extent do, right? The share market is a liquidity medium. The bond market is a liquidity medium. I mean, effectively, otherwise you could just hold it forever and you don't need any trading. And then at the end of the, the period, you get your principal back. In the interim, you've got the coupon or the interest, right? But people like to have the tradability, which is what they're sort of facilitating.
It's fascinating because then it's much more capital light than many of the models that we see in the fintech space. Cool. That's Upstart, trades under the ticker symbol UPST. My second company is in a similar vein. It is Square/Block/ a bunch of other names underneath the hood. So many people will be familiar with Square because it bought Afterpay, and then we've talked at length about this, and then it rebranded as Block to illustrate the emphasis on the blockchain. All that said, it's still the Square many people know and love. It is primarily two divisions, which is the Cash App, which is like a super app for mostly people in the United States who use it to send money around to pay for things, to do things like Bitcoin trading, pardon me, or to cash their checks and so on and so forth. Outside of that, for example, here in Australia, it is massive in the sense that of its point of sale technology. So if you go up to a cafe, small and medium enterprises in particular, or even micro enterprises with the smaller terminal, you can tap your card on that little Square reader or on the screen as it presents to you. You'll know a Square terminal when you see one in the wild, because the cafe owner will be using something that looks like an iPad. So that's basically the way to identify them. And so what did they report? So revenue of US $17.66 billion, an increase of 86% year on year. Gross profit of US $4.2 billion, up 62%. One of the big things is that people say, oh, there's all this Bitcoin revenue that's Block generates. To be honest, don't even look at that because it's so low margin. It's not even worth factoring into your valuation or your analysis. It's kind of just like I don't even know, like a facilitation type thing. It's so low margin. People like it. People like the app for the blockchain style stuff, like being able to transfer to Bitcoin and whatever. But it's primarily the growth outside of that in subscription revenues and things like, trading and just all those different kind of ancillary things that come along with it. Adjusted EBITDA of US $1.01 billion, up 114%. Net income of 166 million, down 22%. So I guess some of the interesting things here are the shares are up here in Australia because now it's dual listed, up 34%. And after hours in the United States, they're up about 28% at the time of recording. So I know you own this one, mate. Well done. So it's a fantastic business that's just getting stickier. We spoke off air. One of the key things to pull out of the report was that around 38% of merchants, so those are the people that are using, the cafes and what have you, that are using the point of sale technology and the so on and so forth. Around 38% of the merchants use 4 or more devices or products. To put that in perspective, 5 years ago, that was at 10%. So only 1 in 10 customers used for more products. So this business, basically every way you look at it, is further entrenching itself into its customers' lives, whether that's on the Cash App side or whether that's over on the seller side. And what is really impressive about Block right now, oh, by the way, Afterpay revenue is not included in the current quarter. So for this annual report, you're not going to see any of that. That happens soon. So that's even more upside for you to look forward to. But one of the things that is kind of really interesting is it's hitting operating leverage. So I'm just going to look past share-based compensation. I know that's a whole thing right now, and just simply take net cash from operations and deduct property, plant, and equipment. For the 2021 financial year, that was $713 million, up from around about $265 million, or 169% increase. So the business is well and truly into its stride. As we know, Dorsey has a lot of plans for the business, whether that's on the blockchain side, whether it's on the super app side. The business is really ticking along, and add Afterpay into the mix, it's looking really good. So very happy with Block at the moment. I would give this an A+. I don't think I've ever given an A+. So this is my first A+, and I'm very excited to give it to Block. And you know what? I'm pretty happy, mate, because it's in the middle of a pretty volatile time in markets. So it's good to have a company jump 20 or 30% in a single day. It's a bit of a reprieve, I guess. I don't know if you had any thoughts. I don't think you've had a great opportunity to look at it yet, because we've been cramming for the other companies, but I bet you're happy.
I haven't looked at it, but I'm happy, and I'm delighted with your thoughts. I'm going to have a look later tonight, but I'm just happy. I think, again, this is a powerhouse in the making. So, and it's great it's listed here in Australia for those people who do not invest directly overseas. I mean, this is an opportunity to get actually an overseas investment opportunity.
Yeah, for sure. I like it. And yeah, SQ2 is the ticker symbol, by the way. Forgot to mention that. Basically to represent Square 2. So GLBE is the company that you're talking about for your third and final company, which is trades under the ticker symbol GLBE. We've spoken about this in the past. Really interesting business. Maybe for those listeners who are a little bit confused about exactly what it does, because I think that distinction with the competitors in the space, or supposed competitors in the space, is really important. Can you just tell us what happened and a little bit about the business?
Yeah, so I'll use an example. So let's say I am Tag Heuer, and I want to sell, my beautiful watches globally. I could set up my own website, which probably I did, and I could set up, subsidiary websites, or have mechanics for figuring out how to sell into Australia, how to sell into France, how to sell into UK, and so on. It sounds like, oh, this should be all simple, but it's not, because there's local currency, there's local VAT, there's local shipping, there's local time zones, there's need for local customer service and things like that, right? It just makes it very complicated. So a lot of companies, of course, have, big companies try to do it on all internally using their own IT teams. Or if you don't want to do it, you can go to a company like GLBE, which will basically integrate their plugins onto one of your main sites, and then make it appear like seamless for customers coming in from other places. And they refer to this as cross-border traffic. So basically, you might have a United States site based in the United States, or a company based in the United States that wants to cross-border sell into Australia. If, like, for example, the Thursday Boot Company, and I want to buy their shoes from the US. Well, this is cross-border, but if you want to make it seamless, you might want to use somebody like GLBE. And this sounds, as I said, but it's very sticky, because once a business is integrated and they start seeing those sales dollars come through, there's very little reason for them to tear this apart and either go to somebody else, because that's risk, or try to do it yourself, because that's even more risk. So these guys partner with Shopify. So Shopify is a platform on which a lot of merchants sell online. They partner with Shopify at the larger end of things, but they also acquired a company called Flow, which was supporting Shopify at the smaller end of things. And acquiring Flow basically made them essentially a company that is now helping Shopify with cross-border, e-commerce. across both the smaller and the larger spectrum of merchants. And that's good because, sometimes you might have a new merchant come on board, they're small, they then become medium sized, then they want to become large, and the needs change. Well, having that entire suite of entire product suite allows you to transition them across these things. So that's the basic idea of the company. E-commerce, I think, has been has been hammered because
For
of
sure.
COVID fears and normalization fears and things like that, right? And what is interesting with this company is that they actually grew their total merchandise volume by 66% year over year. Again, the total merchandise volume going through here is relatively small. It was only $505 million for the quarter, relatively small compared to some of the big wigs. But it was strong growth, and they're predicting strong growth going forward. And part of the reason here is that because they are brand focused, they serve brands and big merchants, even in environments of supply chain constraints and things like that. Brands have a preference of I guess, preferential treatment for their own self versus preferential treatment to other outlets and retailers and things like that. So third parties and marketplaces are second choice for them versus being direct to consumer, right? So they're not impacted by this. And the other cool thing is that they take fees of the service they provide. They also can provide shipping service, which is optional. The fees on or the take rate, effectively, which is the amount of money they make for providing the service, has been very strong and healthy, and has stayed relatively flat for a while, which is really good. Their gross profits are increasing. Shopify is invested in this business, and they're projecting a strong growth into 2022 based on the pipeline of customers that they have. I really like what this company does, and I like how efficient they are. And I like the fact that they're maintaining their take rates, and so if you look underneath, and it's profitable, or break even sort of thing, already at its current scale. And I think cross-border e-commerce is an interesting area. So yeah, I like this company, and I think it's doing well. I'd give this an A. I wouldn't give it an A plus yet.
An A. Okay,
Yeah,
I'll
an
note
A.
that down. An A. Okay. I guess people are a bit concerned, just generally, like with cross-border e-com right now, because of the whole, what's going on in terms of geopolitical stuff. But maybe investors are compensated for that risk right now. Shares are down. It's only a $5 billion company too, right? So it's like, by US standards, kind of like a small cap.
Yeah, it's a small cap. As I said, I think it's a small cap. It's growing really fast, and it's scaling, and it's showing signs of operating leverage. So I mean, look, I think the fears that we see are there. Maybe they'll get hit by supply chain. There's inflation, but I think I feel like if somebody was buying ordinary stuff online because they had no other choice but to buy it online, or they were just bored, those things are the first ones to disappear, right? But if you have to really be a deliberate purchaser to be buying something like a tag heuer, as an example, right? If you're buying something expensive, and on those things you have higher margins, so I think this is just catering to a different customer base. In the PayPal call, one of the things that and this is talking about a different company, their CFO or CEO basically said that they've seen softness from sort of the lower income group, which sort of absolutely makes sense, right? Because that group enjoyed the stimulus funds and spent it, and the other group, those who are relatively well off, are not as sensitive to things like inflation and other issues, right? So if you're willing to buy a BMW, then you'll buy the BMW whether it's $10,000 more or not, because you're paying like 150 grand, right? So at that point you probably you're not going to go buy a Toyota because you started off looking for a BMW. So I think it's just a different customer base. So I think I like this company. It's a small cap growing, and I like the fact that it is partnered with Shopify. That is like having a giant under your corner, and they own a pretty substantial stake in the business.
Yeah,
so
I think that's a key part. Thesis. Yeah. So that's a really interesting business. So we've spoken about it before. I can't remember the episode, but if you're a regular listener, you're probably familiar with it. Fascinating to watch that story unfold, mate. I couldn't help but notice that you mentioned tag heuer a few times, just to round out the conversation. Apple does sell watches. So if you are in the market, you can, there it is right there. You can buy a watch from Apple. And as two very faithful shareholders, we will thank you very much for that. So the final company is a company called Envirosuite, which trades under the ASX ticker symbol EVS. It's a company that we've mentioned, or I've mentioned a couple of times, maybe just in passing, but Envirosuite is an environmental intelligence platform. So what does that mean? It basically provides the software as well as some of the hardware units for organizations to manage their environmental impact. So it's more so like measurement. So things like airports with noise, how much noise they can create. It's basically a social license. You know, if you have an airport in a residential area, how much noise can it create during takeoff and landing? It also does things like, it's basically split into 3 divisions. So it's got aviation, which I just mentioned. It's got something called Omnis, which means everything. That's the literal meaning of it. And that includes monitoring for things like sound, vibration, smell, all those different types of things on industrial plants, energy plants, you name it, ports, those types of things. So that's Omnis. And the 3rd division is this EVS Water. It's a water division, which if you think about it, it's through a combination of acquisitions and licensing of technology. It's basically the value prop is you can go to someone that runs sewers or water mains or anything like that, you know, water plants. So imagine like a council or something like that. And it can run through SUEX or its designer products. It can basically monitor your plant and your facilities for things like corrosion, contamination, all that sort of stuff, and design as well. So this is a really new part of its business. The company, just for those of you that don't know it well, the company does have a bit of a history in terms of acquisition and capital raisings. You can go into I'm sure you can go into like an announcements tab and filter for capital raisings over the years, but it's under new management, which is what I really like about it. The company had a call this week for its first half of 2022 results, and I'll just read out some of those things now. So recurring revenue for the business was $21.5 million. So that was up 7.5%. I think investors were probably expecting more than that for recurring revenue. Non-recurring revenue was up 50% to $5.2 million. So overall revenue is $26.8 million, up 14%. Some of that non-recurring revenue was driven by some of the customers in the Omnis side of things, mainly in North America from the resources or mining sector. So those are non-recurring, which is probably not what investors want to see for the long term, but it's interesting nonetheless. The company did keep a really good lid on costs though. So gross profit up 33%. The thing is, as I asked CEO Jason Cooper on the call, the business is you know, it is a preferred actually employer from a lot of software engineers and the like, because people want to work there because of its focus on the environment and sustainability and those types of things. So people want to work for the company because it's like purpose driven. But one of the things to keep in mind is that operating expenses probably, in my opinion, will probably go up a bit over the next year as they continue to invest in their water division and try and acquire more customers. So the business is not break even, and it probably won't be for another 12 to 18 months, based on my numbers, which I'll just recite here from my summary that I did when I read the results. It looks like, just based on some very crude numbers here, they could be up for, if we base it on ARR of $49 million, non-recurring revenue of $10 million at a 48% gross profit margin. Their gross profit margin is increasing dramatically because they're pushing to the cloud and finding efficiencies. They might churn out about $28 million of gross profit for the next 12 months, but expenses might rise to around 36 to 40 million. So they're going to be going backwards. I guess that just brings into question, like, how are they going to grow out of that cash flow squeeze, and how quickly can they do that? And so one of the questions, again, that I asked Jason on the call was basically, what does the borders reopening mean throughout the world to you? And if you're selling software and some, you know, small hardware units into clients, like imagine an energy plant, industrial facility, you want to get on site. So you want to be there, you want to speak to the customers, you want to understand their needs. And so the reopening is actually a massive opportunity for them to get on the ground and speak to clients and get sites up and running. So that is something that I'll be watching closely over the next year. The move to the cloud is also now more accepted than ever. That they were targeting 50% margins, so they're pretty close to that already. yeah, it's a really interesting business. There's still some risks in the business financially, but they're confident they don't need a capital raising. We'll see about that. But overall, I mean, for environmental focused software on the ASX, Envirosuite's probably one of the top companies in that space. And I like the management team. Yeah, there's plenty of work to do, but I'm pretty optimistic about it in the long run. Very small company, so just go into it with your eyes open. Yeah, I don't know if you have any questions on that, but that's Envirosuite. EVS is the ticker symbol.
I have a generic question. This might be useful for investors. So this company grew in the first half revenue. Revenue is pretty small, right? 27 million. And it over the prior period grew it by only like 14%, right? So that's like, I mean, when you're at, let's say 52 million, 53 million run rate, and you're growing at 14, 15%. How do you think about its, I guess, long-term revenue trajectory? And I guess then how do you think about, them spending for growth, and, how much cash do they need, and sort of, how do you think about valuation for a company that is smallish, nothing wrong in being small and growing relatively slowly, right?
Yeah, so that's the thing. I think we need to take this in context of how things have unfolded. So one of the things that I was really mindful of is when Jason came in, and he's brought a bunch of really impressive people with him. He actually came in the middle of COVID after they just completed the biggest acquisition of all time with teams all around the world, and basically inherited what I would say was a pretty, not ugly Chinese division, we could say. So he's basically come into it in the middle of all that and spent the past 12 to 18 months kind of righting the ship. And I think basically delivered. So I'm willing to back their experience, to back him into this. And the slower growth, I think, is a function of kind of the things that I mentioned, where they're pivoting their not all of their focus, but they're investing heavily in their water business, which has really come out of nowhere in the past few years. They've got some global reference sites now, which are really important for them. And they can finally get people on the ground. He mentioned something that he met up with the top executives for the company in California, which is where he spent a lot of his time professionally. And that wasn't long ago. And that was the first time he'd met them all in person. So from a team perspective, I think that's going to help them grow that recurring revenue really effectively. And it's also going to help them build things like culture, attract good talent in terms of products. Of course, it's all well and good to say that you are a software company in environmental sustainability, all this stuff. Like there's a lot going on there. However, you've got to see that growth. So we want to see, like, the industry as a whole, we would expect to grow with the emphasis on climate change and everything. So we would expect a natural industry growth there. So we would want it to be growing above that rate, ideally, because we want it to be growing, faster than the industry, capturing more share of that industry, so on and so forth. So that's how we can monitor that going forward. Capital raisings, obviously, we probably don't want to see any more of that. If we can turn our back on that for good, that would be a kind of a red flag in time, I would say, for investors who have been around for a long time. And obviously, we want management to be appropriately incentivized to add per share value. So I guess that doesn't really answer your question, but I want to see ARR growing quickly, but I think it can, because there'll be more sell-through over the next 18 months, and willing to back management.
Cool. So I'll say that there's some potential for green shoots here. So watch for those green shoots, and stick around if the green shoots are there.
Yeah. So I'll give it. You had to do it. Fair enough. I'll give it a B+, because I still want to see more of that ARR growth. That's basically that would push it into the A territory. It needs to get more of that ARR growth. ARR growth for an A. But mate, I thought we're coming to the end of the show now. We know that people can get in touch with us. I'm at Owen Rask. You're at 7A Mahanti on Twitter. I will put all the links in the show notes if you're on your podcast player and you want to ask either of us a question about the companies we just spoke about. Just click the link, go through to Twitter and send us a message. But it is also February 25th, as I check it on my iMac here. That means a 7 investing stock idea is coming out in the next few days. Can you tell us anything at all? Give us a bit of a promo. Come on, pump it up.
Okay. So there's some very fascinating companies on this upcoming months list, some really fascinating ones. Okay, let me give you the hint. This month, there's a very good mix of internationally flavored ideas, companies that are either internationally headquartered or listed overseas, listed in the US, but internationally headquartered or founded by, immigrants. So it's like, it's a bonanza in that sense. What is my company? My company is a very exciting company, growing free cash flow, earnings growth through the roof. Just scratched the tip of the surface in terms of the market opportunity, and
Interesting.
it's an exciting, it's a great company.
Interesting.
It's a great
Interesting. Yeah. So this is what I love about the 7 investing team. All of the advisors get a chance to pick one stock every month. And I do see the hints and the videos on Twitter. I think it's a great idea. I think it changes kind of how we think about the businesses that you and I work in, which is like giving investment research to investors. I think it's just exciting. It's fun. And that's the way investing can be. I know that's not necessarily the way a lot of conventional investors look at the industry, but I think it's what people want to hear. So you can head to 7investing.com/subscribe. You can use the Rask code. That's RASK. Just pop that in there and you can get access to Anirban's latest pick and all of the picks from the past, as well as the entire 7 investing team. And by the way, Rask doesn't get anything for that. Just we work on the show together. That's all we do. And you can head to rask.com.au. That's RASK. And you can take one of our investing courses or download a free report from me and the team at Rask. So, mate, as always, it's an absolute pleasure. Thanks for joining me.
Thanks for having me, Owen.